All right, so we're going to get started and we're going to talk about Chapter 3. Now, Chapter 3, I have to warn you, is kind of where we might start losing some folks. This is where the material starts to get a little more difficult. Um, and that's just the nature of accounting. At this point, we're going to start talking about the more technical aspects of accounting. And in particular, in this chapter, we're going to be discussing the transactions that we're going to record and measure during the accounting period. Okay, so we're going to talk about three things. The first is going to be measuring those business activities, and then we're going to prepare some preliminary financial statements. Okay, we will, of course, have to correct those or have to make adjustments and prepare final financial statements, but we'll do that in Chapter 4. And then finally, we're going to talk about two things that are really very important in accounting. It's difficult to talk about accounting without talking about these two things right here, debits and credits. So I really want you guys to make sure that you are familiar with these two concepts and that you know how to work with them, because we're going to be doing a lot with debits and credits, at least for the next couple chapters. After that, we may pull the reins back a little bit and just talk about things in terms of increases or decreases. But for right now, we've really got to learn those debits and credits parts of this chapter. So we're going to do a quick review, and we're going to talk about what is the function of financial accounting. Why do we do financial accounting? And it really is so that we can measure those activities, so business activities of the company. And then we're going to record those transactions. So those business activities that actually impact our financial statements, that impact our financial accounting equation, those are what we call transactions. And we're going to record those transactions. Okay. So you can see here, transactions are events that impact some component of our fundamental accounting equation. And again, that fundamental accounting equation is going to be A equals L plus E. Right, so assets equal liabilities plus equity, or in other terms, the resources available for our company equal the claims to those resources, whether that's from creditors or from owners of the company. Okay, and then these financial statements that we produce, those are the way we communicate the measurements and the recording of those measurements to external parties. Those are the investors, the creditors, the government, whoever's interested in this, right? So we communicate those, like I said, using the financial statements, and those financial statements are the income statement, statement of shareholders' equity, balance sheet, and the statement of cash flows. Okay, so if you'll notice, these are the order that we prepare these in. First, the income statement, net income, goes to your equity, your statement of shareholders' equity. Retained earnings goes from there to your balance sheet. You prepare your balance sheet, and then your cash goes to your statement of cash flows, which is the last that we prepare. And that statement of cash flows, again, is just a complementary statement to show us what did we do with cash this year. These different measurements, all these measurements and the communication. So step 1, the measurement process, and then we go to step 2, the communication process. Okay. Those are all those two things are when you combine them, that's what we call the accounting cycle. Okay. So what are the effects of transactions on assets, liabilities, and stockholders' equity? So really the way this is going to work is that when we record these external transactions, right, we record them with different individuals and different companies, okay? We have to measure them. We must measure and communicate these. Measure and communicate, right? Step 1, step 2. Again, when we see these, we need to think this is financial accounting. This is the accounting cycle. Okay? So we're going to focus on this chapter on what happens during the period. Okay? So during the month. What are we doing during the month? Okay? So the first thing we've got to understand with accounting when we're talking about the technical aspects of accounting is each transaction is going to have a dual effect. Dual meaning two, right? So you're going to have two effects on your accounting equation. What is our accounting equation? Again, it's just A equals L plus E. We're going to look at that simple right now. Okay. So you're going to need to know some things when you're recording these transactions. You're going to need to know the account. Okay. We record all of our transactions related to a particular item during a period of time. Okay. Some sample asset accounts are cash, supplies, equipment, inventory. Those are all assets. Liabilities, like I told you guys, are going to be your accounts payable, your salaries payable, your utilities payable, your taxes payable. So anytime you see that word, anytime you see payable, just know that means liability. Okay, it's going to be a liability account. Okay, now you'll have to determine whether that's a long-term or short-term liability, current liability, but if you see that word payable, it's going to be a liability. And then you've got your stockholders' equity account, and right now, as far as we know, there's only two, common stock and retained earnings. Okay, so we know that there are other components of retained earnings, but we'll talk about that as we get further into this. So the balance of the account. Okay, so when we talk about the balance of the account, what is the balance in your cash account, right? So the balance of your cash account is going to determine, is going to be any increases in the account minus any activities that decrease the account, right? So if you have cash, for instance, okay, let's say we have cash and we start with $500 and we use $100 of it, but then we get another $200 and then we use $400 of it. What is our ending balance? It's $200, right? So we used 500, we had 500, we used 100, that gives us 400. We added 200, that's going to give us 600. And we subtracted for it, we used another 400, that gives us 200, which is our ending balance. So that's what we mean, right? It's all those activities that increase the account minus any activities that decrease the account. And with cash, as we'll learn, we add on the left and we subtract on the right. Okay, and we'll talk about that a little bit later. So once again, just reiterating the basic accounting equation: assets equal liabilities plus stockholders' equity, or as we've said several times at this point, your resources equal the claims to those resources, whether those claims are from creditors or those claims are from owners, shareholders, that sort of thing. So again, this is so important. Okay. You need to be familiar with this equation. Okay. Not just memorize it, but understand it, because a lot of what we're going to do in this class is simply talking about the impacts that different transactions have on this accounting equation. And then we've got our expanded accounting equation. Okay, so we take our basic equation right here, your A equals L plus E, and then we're going to look at the other parts that make up equity. Okay, because assets are assets, whether they're current or long-term, and liabilities are liabilities, whether they're current or long-term. What we really need to break down is, what do we consider equity? Well, paid in capital or contributed capital. Paid in, contributed, same type of thing, right? That's going to be your common stock for right now, okay? Those are external sources of equity. Then we have internal sources of equity: net income, or retained earnings, excuse me. What are retained earnings? Well, they are the net income, okay, that you get to keep, that you get to retain after you pay dividends. Okay, so it's net income less dividends equals retained earnings. That's what makes up retained earnings, and that is internal capital, right? Everything that's left after you pay dividends is the owners. The owners own this. Okay, so this is your expanded accounting equation. This is the sphere that we're going to work in most of the time. And you'll be able to follow things like revenues, gains, expenses, and losses. Where do these go? They go to your income statement, right? Dividends, retained earnings statement. Okay, so you'll be able to follow it from the income statement all the way up to your balance sheet. Okay, so you'll notice that something that impacts your income statement eventually is going to impact your balance sheet. So be familiar with this equation as well. You want to be able to talk about the components of the accounting equation.